Welcome, I'm Raj Venugopal. Today we are going to talk about real estate investment trust. Real estate investment trust, also known as REITs, were created in US when President Eisenhower signed into law the REIT Act. The purpose of the law is to give an opportunity for common investors to invest in large-scale diversified portfolio of money-making real estate asset by buying and selling securities from a publicly traded market. Since then, more countries around the world cleared way in investing in global real estate securities, paving way for individual investors to invest in large-scale commercial and residential real estate securities. Buying and selling REIT securities is one of the best way an individual investor can safely invest in real estate and expect a decent return on their investment. Let's say you have $25,000 in cash and you are interested in investing in real estate. It is not possible to buy a real estate property for that money and expect a decent return on your investment in the form of rent. Moreover, it is not safe for an individual investor to loan money to an unknown homeowner who requires a home mortgage loan and expect an income from the interest earned on the loaned money. This is where REITs come into play. Real estate investment trust is an investment security that buys and sells its stock in major stock exchanges. They invest in real estate properties and make money through interest earned from mortgage loans and through rent earned from the real estate properties. These are known as publicly traded REITs. This provides an opportunity for individual investors to earn a share of income through ownership of commercial and residential real estate properties and mortgage loans. The income producing real estate properties include apartments, home mortgages, shopping malls, office building, resorts, golf courses, storage facilities, etc. For a company to qualify as REIT, it must have most of its investment in real estate and must distribute at least 90% of its income to shareholders in the form of dividends. This results in higher dividend yield to the shareholders, ensuring a good cash flow and a decent return on their investment. Since most of the taxable income is returned to shareholders directly, the dividend is subject to higher tax rates. REIT shares are bought and sold on major stock exchanges. In contrast, buying and selling real estate property directly involves higher expenses, property tax liabilities, and a great deal of effort. In general, there are three types of REITs: mortgage REIT, equity REIT, and a hybrid REIT. Equity-based REIT primarily invest their money by owning real estate properties. The primary source of income comes from rents generated by the real estate assets. As years goes on, the rent and the property value goes up, resulting in higher dividend and a higher stock value. This is one of the safest and the popular choice of investment. Mortgage-based REIT invest their money by owning real estate mortgages. They loan money to real estate investors in the form of mortgage loans. They also purchase existing home mortgage loans and mortgage-based stock investments. The primary source of income comes from the interest earned by these mortgage loans. Mortgage-based REIT has a higher dividend pay than the equity-based REIT. Mortgage REITs are highly volatile and subject to high fluctuation due to interest rate changes, whereas equity-based REITs have a stable growth and less volatility. Due to its high yield dividend, the investment pays itself off to the investors in few years. Even though these trusts seems attractive because of higher dividend yield, it carries a higher risk because of the exposure to interest rate. If the interest rate goes up, the value of the mortgage REIT goes down. Best time to invest is during recession time because that's when the interest rate is expected to go down and the spread rate between their income from their mortgage asset and the cost from their borrowed money widens, resulting in higher profit. Hybrid REIT invests in a mix of above both strategies. Income gets generated through mortgage interest and real estate rents. REIT's advantages: high dividend, meaning it is a great source of cash flow for investors focused on high yield dividends. REITs are liquid assets. The assets can be bought and sold in public stock exchange without affecting the asset price. You can sell your shares online and get your money back immediately. Diversified real estate portfolio. meaning money is invested in REITs by the investors like you allows the trust to purchase more real estate properties than an individual investor would be able to buy on their own. Hassle-free investment, meaning provides investment access to real estate asset without the overhead of property tax, management fees, and legal issues. And finally, asset appreciation. REIT equity appreciates in value over time. Now, REIT's disadvantages. Most of the REIT dividends are not qualified for tax breaks, so they are taxed at ordinary income rate. When the real estate market goes down, the asset value goes down as well. This will reduce the share value of the stock. Dependency on occupancy rate. Less renters will lead to decrease in occupancy rate, and that leads to lesser revenues. This will get reflected in the dividend payout. Now, fourth one is stock fluctuations. The shares are subject to fluctuation caused by short-term traders. And finally, interest rate risk. Increase in interest rate will hurt the dividend payout for mortgage-based REITs. Now, thank you for listening. Enjoy and have fun.